Hello, everyone, and welcome back to the deep dive. We are very glad you could join us as we take just a monumental stack of research and really try to cut straight to the analysis you need. Today, we are breaking down one of the most recognizable and frankly often debated companies in the world, Airbnb, ticker ABNB. And, on the surface, the business quality looks phenomenal. I mean, it is a global disruptor. It's got this asset-light model, margins that are virtually unheard of in the travel space, and a brand that's achieved that coveted verb status. But here's the central question, the one that really dictates its long-term viability. Is the current sort of premium valuation justified? Or are there genuine structural threats? I'm talking severe regulatory headwinds and competitive challenges that are finally beginning to eat away at the core business. So our mission today is to break down the actual endurance of that competitive fortress and to identify the specific risks that could, structurally impair the business for you, the long-term owner.
That is absolutely the only question that matters for anyone considering ABNB over the next decade. The difference between a generational compounder and, well, a value trap lies entirely in how durable that fortress proves to be. Before we dive into the competitive landscape and all the details, just a quick note for everyone listening.
Yeah, for those of you looking to act on these investing ideas and maybe explore these businesses in more depth, having a professional-grade platform that can handle global markets, sophisticated analysis, it's just absolutely key. We use interactive brokers, and we've actually partnered with them. They are offering our listeners a stock bonus when you sign up and fund your account. It's a really powerful platform for accessing global markets.
So you get a bonus to help kickstart your portfolio, and you support the deep dive at the same time. That link with all the relevant details is right there in the description that accompanies this analysis.
That's right. And if you find value in this kind of, in-depth structured analysis, please make sure you hit that subscribe and like button. It is the single best way to ensure the delivery of the next deep dive directly to you. And please tell us what stood out to you in the comments section. We love to see the engagement.
Perfect. Let's not waste any more time. We need to start with the foundational quality of this operation. Pillar number one, the business model and the enduring competitive fortress.
Okay, let's unpack this because it really is brilliant. The core of Airbnb is it's deceptively simple. It's a pure two-sided marketplace executed globally through technology. You have the host, right, providing unique supply, and the guest providing massive global demand. It is, by definition, a matching engine. And the revenue generation model is just as streamlined. It's a service fee charged on every single booking. Typically, it's around 3% from the host and usually 14% to 15% from the guest, sometimes a bit more. That total take rate, call it roughly 17 to 18%, is captured as pure transaction revenue.
And that seemingly mundane detail, the fee structure, is what unlocks the profound financial advantage. Airbnb is an asset-light capital aggregator.
Right.
They own zero physical real estate inventory. They don't maintain staff, clean rooms, or handle property taxes for any of the millions of listings on their platform.
It's an incredible model when you contrast it with the traditional hoteliers.
Exactly. Think about a Hilton or a Marriott. They are capital-intensive operations. They have to constantly raise and deploy billions in capital to build new hotels, or they pay these hefty management fees to maintain aging physical structures. Airbnb's only substantial investment is in software, trust and verification, and of course, brand maintenance.
So that asset-light structure, it isn't just a buzzword.
Not at all. It's the structural reason their return on invested capital, their ROIC, is consistently north of 30%. They generate massive profits without owning the expensive assets. I mean, that is the definition of superior financial leverage.
And the endurance of the model, I think, is tied to a fundamental behavioral shift. COVID definitely accelerated it, but it didn't create it. We are structurally moving away from that standardized tourism of the past, that generic cookie-cutter hotel room. We're moving toward what Brian Chesky calls living anywhere.
Exactly. And I think this shift is permanent. Remote work has blurred the line between housing and travel. It's just a fact of life now. Travelers today, especially families or long-term travelers, they are demanding local authenticity. They want a kitchen. They need more space. And they need it for longer durations. So Airbnb isn't just monetizing a transaction. They are monetizing trust and the utilization of underutilized assets. They are benefiting from a vast structural change in global consumer preferences. It's a tailwind.
Okay, so if the model is that simple, the defense must be complex.
Yeah.
So let's talk about the moat, which we would define as the global network effect. I mean, if someone wanted to copy the software, they could, but they cannot copy the network.
This is their primary enduring competitive fortress. It's often called the liquidity moat.
Yeah.
A network effect is valuable when every new user makes the platform better for everyone else, right?
Right.
For Airbnb, this is just a beautiful, virtuous feedback loop. Guests are drawn to the platform because it offers the most diverse, unique, and geographically spread out listings globally. You can literally rent a windmill, a castle, a yacht.
And on the other side.
Conversely, hosts are drawn to the platform because it instantly delivers massive global demand. Millions of travelers ready to book.
And the strength of that network, it creates an almost insurmountable chicken and egg problem for competitors, doesn't it?
Oh, absolutely.
Let's elaborate on that challenge because it's so crucial. Let's say a rival raised, I don't know, $5 billion and decided to launch tomorrow in, say, Paris. They wouldn't just need to convince 50,000 hosts to list their homes.
No, and that's the hard part.
They'd have to simultaneously convince millions of global travelers to change their habits and start booking on this unproven platform, like right now.
The barrier to entry isn't the technology, which is replicable.
Right.
It's the liquidity, that depth of supply matched with guaranteed demand, and the established years-long trust between the two sides of the marketplace.
And this scale, it translates directly into an often underestimated financial weapon, brand power.
The brand has reached the status of a verb. You don't book a short-term stay, you Airbnb it.
That verb status allows them to bypass what we investors call the Google tax. Now, why is this so critical financially?
Because the rivals, particularly Booking.com and Expedia, they're selling highly commoditized inventory.
Generic hotel rooms.
Exactly, generic hotel rooms.
Right.
So they are locked in an internal billions of dollars advertising war. They have to spend 10%, 15%, sometimes 20% of their revenue fighting each other on paid search and performance marketing just to acquire a booking.
So they're essentially renting the customer from Google.
They are buying the customer, and that massive cost directly impacts their margins. Airbnb, because of that inspirational, powerful brand, generates approximately 90% of its traffic directly or via unpaid organic channels.
90%.
Think about that defensive pricing power. While competitors are constantly depleting their operating cash flow to feed the Google machine,
Right.
Airbnb is deploying that same capital into radical product R&D, improving the customer experience, or returning it to shareholders via buybacks. It's a durable 10 to 15% structural margin advantage year after year.
And the moat isn't just strong either. It actually appears to be widening through their strategic expansion. While competitors like Booking.com are intensifying pressure in the traditional short-term rental market, Airbnb is strategically moving into new territory, long-term stays, which they define as anything 28 days or longer.
This is the genius of category expansion. The long-term stay market is one that traditional hotels are fundamentally, structurally incapable of serving profitably.
Why is that?
Well, their operating models, daily cleaning, front desk staffing, utility costs, it all falls apart when a guest stays for 2 months. It's just not built for that. Airbnb, which is merely a software platform connecting two parties, facilitates this easily and profitably. By capturing this segment, they are locking in users who now view the platform not just as a fun tool for a weekend trip, but as a legitimate housing solution for digital nomads, people relocating, or extended family visits. That makes the platform essential, not discretionary.
To really internalize the momentum of this business, I think we have to look at it through the lens of established business mental models. Let's start with the flywheel effect, the concept popularized by Jim Collins.
The flywheel perfectly illustrates the company's trajectory. Pushing that initial heavy wheel, getting the first host, convincing people to trust a stranger in their spare bedroom, that was brutally difficult.
Oh, I remember the stories.
We forget how hard that start was. I mean, Chesky was famously selling collectible cereal boxes, Obama O's and Captain McCain's, just to fund the company in the early days, just pushing that heavy inert wheel.
Right.
But once that mass and velocity were achieved, the momentum became self-sustaining. More unique hosts attract more guests, which leads to more data, which leads to a better product, which attracts even more hosts. It's, spinning itself now.
And then there's Metcalfe's law, which governs network utility.
Right. Metcalfe's law states that the value of a network increases geometrically with the number of users. And this is so important because Airbnb's supply is unique. It's not commoditized.
It's not just another hotel room.
Exactly. Every new host who offers a unique experience, a vintage Airstream, a secluded cabin, or an apartment in an underserved neighborhood adds unique, non-fungible value to the network. This uniqueness turbocharges the network effect utility, making the network exponentially more valuable as it grows.
Okay, now let's pivot to the customer experience, because this is where the competitive fortress has some, let's call them genuine structural maintenance issues. We've done the qualitative research, the Scuttlebutt simulation, and what we see is a clear barbell distribution of customer sentiment.
That is a critical observation.
Yeah.
And when we say barbell distribution, we mean there is almost no middle ground of customer feeling. They are rarely ambivalent.
No one says Airbnb was fine.
Exactly. They either intensely love the platform deep evangelism from families who need the space in the kitchen, or travelers looking for that unique connection, or they intensely resent it. And that resentment is primarily due to cost opacity.
And it centers squarely on the chore lists and the often opaque cleaning fees. I mean, when you book a 2-night stay and the final cleaning fee inflates the cost by 50%, and then you are asked to load the dishwasher and strip the beds, that friction, it risks eroding the brand premium entirely.
That friction is the enemy of the liquidity moat, and you are right to challenge it. If people lose faith in the core experience, they default back to the known quantity, the standardized hotel.
So what are they doing about it?
What is encouraging is management's recognition and responsiveness. They've actively worked to address this, most notably by implementing the total price display. They now force hosts to show the all-in cost up front, removing that sticker shock that plagued the platform for years.
Okay, that's a big step.
It is, and they are also aggressively cracking down on excessive or unearned cleaning fees and enforcing higher quality standards. It's not a perfect fix, but it shows they understand that preserving the integrity of that unique, high NPS core user base is paramount.
We must also acknowledge the competitive landscape realistically. I mean, Airbnb is not operating alone. Booking.com and Expedia are formidable rivals.
Absolutely. Booking.com is an operational juggernaut, particularly in Europe and Asia. Their strategy is often summarized as everything for everyone, and their scale and efficiency in traditional lodging are just massive. Expedia, through Vrbo, is a very serious competitor in the U.S. whole home vacation rental segment.
So if they are competing with these giants, where is Airbnb's durable edge? Where does it really lie?
It remains in two areas, brand and exclusive supply. While professional property managers will list their homes on all three platforms, and that's a trend that Airbnb needs to manage carefully, the true soul of the platform, the individual host renting their spare room, their unique primary residence, or that bizarre treehouse that is often exclusive to Airbnb.
And that's the supply that's hard to replicate.
It's difficult, if not impossible, for rivals to replicate. Furthermore, their competitive advantage is tied to the customer search intent. Booking.com excels at the destination-led transactional search. I need a standard room in Madrid next Tuesday.
Right. Very functional.
Airbnb dominates the inspiration-led emotional search. I want a rustic mountain cabin experience for my family holiday. They cater to different travel needs, which gives them a protective layer that pure transactional aggregators don't possess.
Okay, so this establishes the foundation. We have a structurally superior business model, strong network effects, but with these internal friction points that require active management. Now, let's pivot to Section 2 and analyze the people running this machine: management, stewardship, and financial resilience. And we have to start with CEO Brian Chesky. He operates with a textbook owner-operator philosophy. This isn't just talking points either. We see it in his explicit rejection of the typical short-sighted quarterly earnings cadence.
That's unusual.
He tells the market openly that he focuses on long-term horizons, design-led innovation, and major biannual product releases rather than, incremental announcements designed simply to beat consensus estimates.
That alignment is so crucial for long-term compounders. High insider ownership and the founders' voting control mean that their personal wealth and incentives are perfectly aligned with long-term share price performance.
So they're not just playing for the next quarter.
Not at all. They are not incentivized to pump the stock for a quick payout. They are building a generational company. They have the authority to make unpopular short-term decisions, like increasing transparency on cleaning fees, for the long-term health of the brand.
And the ultimate test of leadership is not how well they perform during a bull market.
It's how rationally they allocate capital during a crisis.
Yeah.
And the COVID-19 track record here is a masterclass in discipline. They were one of the companies hardest hit initially, yet management demonstrated immense fiscal discipline. They cut over $1 billion in fixed costs without structurally damaging the core platform.
And we saw the results of that rationality test when they made the difficult decision to kill the non-core distractions, the pet projects.
Yeah.
We're talking about expensive ventures like their internal transportation concepts, their studios division, and other vanity projects that were just sucking capital and management focus away from the core host-guest platform.
Shutting those down was proof that they could preserve the golden goose, even if it meant painful concessions on cherished ideas.
And that focus has resulted in really a world-class capital allocation strategy today.
It's balanced, which is hard to achieve. They are heavily reinvesting in R&D to continuously improve the user experience and deepen their category ownership. But they're also executing substantial share buybacks. We're talking billions authorized.
And what's the purpose of those?
They're used primarily to offset stock dilution from employee compensation. They are prioritizing efficiency and shareholder value creation over, say, M&A empire building.
Now let's talk about the financial transformation, because the financial structure of this company is now a true fortress. The crucial shift post-IPO was moving away from that growth at all costs mentality.
The mentality that has destroyed so many Silicon Valley darlings.
Exactly. They moved to a deep commitment to profitable growth.
That transition has solidified their financial profile. Their net income margins have stabilized consistently in the impressive 20% plus range.
That's high for this space.
For a high-growth, globally scaling technology platform, that consistent, high-level profitability is exceedingly rare. And their balance sheet, it's pristine. They hold billions in liquid assets, well over $10 billion in cash and equivalents with manageable debt, which confirms their absolute ability to weather severe global economic downturns without requiring external capital.
But the true fundamental magic, I think, lies in two key quality ratios, and they're both direct consequences of that asset-light model.
The first, as we mentioned, is the return on invested capital, ROIC, which is consistently exceptional, often peaking above 30%. We have to stress why this is so high. Traditional businesses need to sink capital into long-lived, depreciating assets, the hotels, the trucks, the factories.
All that physical stuff.
Right. Airbnb's capital base is minimal. Therefore, the incremental capital required to facilitate the next million bookings is negligible. When capital required is low and profit generation is high, your ROIC explodes. This is a profound signal of durable advantage and management efficiency.
And the second, and maybe the most important qualitative sign of business health, is their free cash flow conversion. This is truly world-class. It's pushing FCF margins into the 30% to 40% range consistently.
This exceptional cash conversion is due entirely to the phenomenon of the negative working capital cycle.
Let's break this down completely because it's a massive self-funding advantage.
Okay, so when you, the guest, book a stay, you often pay Airbnb the full amount weeks or even months before you check in. This cash is deposited immediately into Airbnb's accounts.
Okay.
However, Airbnb does not pay the host until after you have successfully checked in and the stay has begun.
So they hold on to the customer's money, what is recorded on the balance sheet, as deferred revenue for an average period of, maybe 30 to 60 days?
Precisely. That float of customer money is essentially a massive free, interest-free loan from millions of customers.
And they can earn interest on it.
They can earn interest on that float during the holding period. This reliable, non-dilutive internal source of funding is a perpetual cash-generating machine. It means that Airbnb is paid to grow, unlike most companies that have to finance their growth through debt or equity. This is a unique and durable financial advantage few competitors can match.
Okay, so we have established the quality of the model, the durability of the network, and the superiority of the financials and management. Now we must transition to the critical Section 3, valuation, risks, and unpriced catalysts. We have to determine if this magnificent machine is worth the current price tag. And the valuation profile has definitely shifted recently. During the pandemic and the post-lockdown boom, ABNB commanded a massive premium. It was often trading at 30 to 60 times earnings because of its perceived hypergrowth potential and unique status.
But as that post-COVID euphoria normalizes and growth decelerates to a more steady compounder rate, the multiple has compressed significantly. Trading around the 128 FLI as a share mark, it's transitioning from a purely speculative growth stock to a classic growth at a reasonable price, or Ajarab story.
So not a bargain, but not outrageous.
It's certainly not cheap, but for a business with these network effects and this margin profile, it is becoming fairly valued relative to its long-term potential.
For a tech platform like this, finding a margin of safety is always a challenge. I mean, book value is irrelevant here.
Completely irrelevant. The value is entirely tied to the software, the brand, and the network. The true margin of safety is found in the sustainability of those FCF yields. We are safer when the current price implies a highly pessimistic scenario. For example, if you ran the numbers, and the current market price only makes sense if the company generates zero future growth in listing supply globally.
Which seems unlikely.
A highly pessimistic scenario. Then you know there is a behavioral margin of safety built into the stock due to that regulatory fear. We believe the current price is far more generous than that worst-case scenario.
That being said, the ultimate determinant of success for an investor here is not the entry price today, it's duration. If you can hold this stock for 10 years, allowing the compounding of FCF and the expansion into new verticals to fully play out, the current entry price will likely look negligible in hindsight. But if you try to hold for just 12 months, you are entirely at the mercy of multiple contraction and unpredictable regulatory headlines.
Let's discuss the primary engine driving that long-term compounding, which is international expansion and penetration. While the US, Canada, and core European markets like France and Italy are approaching saturation, large untapped markets remain the core growth lever over the next decade.
Where specifically are we talking about?
We are talking about massive, affluent markets like Germany, Brazil, and especially Japan. These countries are significantly underpenetrated in terms of Airbnb listings per capita compared to the US or France. Successfully penetrating these areas, adapting to local consumer preferences, and navigating local legal frameworks. That is the baseline assumption for generating the necessary 15 to 20% growth rates required to justify the valuation long term.
Okay. Now we must address the shadows, the permanent impairment risks. These are the threats that could structurally damage the business quality, not just cause a temporary stock dip. Risk number one, the existential threat, is regulatory strangulation. We have seen major global cities effectively ban or severely restrict short-term rentals, and this is the biggest overhang on the stock.
And the problem is not the fines. The problem is the erosion of the total addressable market, the TAM. Let's look at the operational specifics. In places like New York City, Local Law 18 makes it virtually impossible for individual hosts to rent out non-primary residences for less than 30 days without extreme bureaucratic hurdles.
Like requiring the host to be physically present.
Exactly. Similarly, Barcelona and Paris impose strict limits on the number of nights a host can rent a secondary property. If this localized action becomes a global contagion, if the top 20 global demand centers, which drive a significant portion of platform revenue, effectively cut off unique supply,
the TAM could collapse.
The short-term rental TAM could structurally collapse. If demand is forced to move entirely to the periphery, or if hosts simply give up due to complexity, the unique inventory that fuels the brand premium disappears. That is the true nightmare scenario for shareholders.
But let me introduce some friction here. The counter-argument we hear is that regulation is often chaotic and targeted specifically at party houses and, investor-owned, non-primary residences. Doesn't that regulatory heat mainly eliminate the bad inventory and thus actually improve the overall quality and preserve the brand's soul?
That's a nuanced and essential point. It's true that eliminating poorly run, high-traffic professional listings helps the user experience, but often the legislation is drafted so broadly that it also captures the casual, individual host, the very soul of the platform.
So the small operator gets caught in the crossfire.
The regulatory burden often falls hardest on the small operator who can't afford legal compliance. Which brings us to risk number two, the loss of soul or commoditization. If, in an effort to comply with global regulations and to scale rapidly, the platform continues its shift toward aggregating only large professional property managers and standard vacation rentals.
It loses its defining feature.
Exactly. It loses unique, inspiration-led supply.
And if they lose the tree houses and the unique local apartments, they're forced to compete directly on price and commissions with Booking.com and Expedia,
who are world-class at transactional search.
Right.
Precisely. That is the commodity trap. In that scenario, Airbnb loses its brand premium, its defensive pricing power vanishes, and its industry-leading margins compress rapidly toward those of a generic online travel agency. This would constitute a structural impairment of the business model.
But the investment thesis isn't just about risk mitigation. We have to talk about the unpriced optionality and catalysts, the massive growth levers that are currently sitting outside of the valuation model because they haven't been fully deployed.
There are two truly massive levers here. The first is the experiences reboot. The experiences segment local guided tours, cooking classes, unique activities. It stalled in the past, largely due to COVID and the focus on the core business.
But the market potential is huge.
It's a potentially massive, high-margin vertical. They already have the users, they have the trust mechanism, and they have the local knowledge infrastructure. Applying the network effect to local activities, connecting demand, so tourists with unique local supply like guides, chefs, artists, is a huge fragmented market that traditional aggregators haven't cracked.
So if Chesky refocuses there?
If Chesky refocuses the design-led innovation here, the revenue could be material and extremely high margin.
And the second, and perhaps the most powerful and immediate financial catalyst, is sponsored listings, advertising revenue.
Airbnb has barely tapped into advertising revenue, which is a key component of every other major two-sided marketplace globally. Think Amazon, think Etsy.
So allowing hosts to pay for better placement.
Allowing hosts, especially professional hosts, to pay for premium placement when travelers search for a listing is the definition of low-hanging fruit. This is a multi-billion-dollar pure profit lever waiting to be pulled.
Wow.
It requires minimal extra investment. It's just a software feature. And virtually all of that revenue immediately drops to the bottom line, significantly boosting FCF margins. This optionality is not priced into the stock at all because they have been so hesitant to implement it, prioritizing user experience over short-term revenue gains.
But when they do pull that lever,
The market will re-rate the profitability profile instantly.
this brings us to the crucial exercise of second-level thinking. What is the market consensus, and how do we challenge the core assumptions?
The market consensus is built on fear. It's the post-COVID boom is over, growth is slowing, regulations are aggressively eating away at their core supply in key cities, and thus, growth will stall at low double digits, making the current premium multiple unsustainable.
So the contrarian view has to challenge the assumption that regulatory action fundamentally cripples the platform. We need to emphasize the profound adaptability of the supply and, crucially, the durability of the demand once it's locked into the ecosystem.
Look at the NYC ban example you mentioned. When that strict ban hit, demand didn't just vanish. The guests who needed a 3-bedroom apartment for a month didn't suddenly decide to check into a tiny hotel room.
Right, their needs didn't change.
Their needs didn't change. Demand simply shifted immediately to surrounding legal areas like Jersey City or filtered into legal alternatives within the platform.
This is what we call the Roach Motel theory applied to platforms.
Exactly. Guests check into the ecosystem, they trust the brand, they use the app, they value the unique offering. They don't check out. They migrate their demand to the next available legal alternative inside the platform's boundaries.
And the long-term stays are key to that.
The key strategic shift is the increasing use of long-term stays, 3 to 6 months, which are usually exempt from short-term rental ordinances. This allows the platform to absorb regulatory shocks by migrating the revenue to a legally viable category.
But let me challenge that adaptation. If all the revenue shifts from high-density, high-price Manhattan to lower-priced Jersey City, that's still a revenue haircut. And it changes the entire narrative from a global travel platform to a localized housing platform. Doesn't that fundamentally compress the growth ceiling?
It absolutely introduces friction, and it lowers the ceiling in those specific saturated markets, no doubt. But the point is that the platform's ability to pivot prevents a total collapse of the TAM. The overall growth narrative shifts from deep penetration in already served markets to aggressive penetration in currently unregulated international markets like Germany and Japan, and simultaneous expansion into new categories like long-term stays that bypass the core regulatory risk entirely. They are trading high growth rates in legacy markets for highly resilient, sustainable growth in new categories. That is the core of the bull case resilience.
That brings us to Section 4. The final investment memo synthesis. Let's distill the argument into the final bull and bear memos. Let's start with the bull case summary, the core reasons for ownership. Number 1, unmatched network effects and a strengthening moat due to unique supply, supported by that generational shift to living anywhere. Number 2, it is a world-class cash flow machine, generating massive FCF margins in the 30 to 40% range, thanks to the negative working capital cycle and the asset-light model. Number 3, the deep, unpriced optionality we just discussed. The founder has the authority to unlock massive new high-margin verticals like advertising and experiences that could instantly re-rate the profitability of the company. And finally, number 4. Exceptional brand power, which provides a permanent structural cost advantage by allowing them to bypass that costly Google tax.
On the flip side, the bear case summary provides the necessary counterarguments. Number 1. The regulatory cap. If the localized regulatory action becomes a global contagion and the top 20 demand cities enforce aggressive bans, the overall market growth structurally stalls. International expansion simply cannot compensate for the loss of core revenue. Number 2. Price sensitivity and commoditization risk. Cleaning fees and service fees make short, transactional stays expensive compared to hotels, risking the loss of the budget-conscious traveler. This could force them into direct price competition with Booking.com, leading to catastrophic margin erosion if their unique supply vanishes. And number 3, the maturity wall. The law of large numbers is unavoidable. Revenue growth is decelerating into the low double digits, which may not justify a sustained premium valuation unless that optionality is unlocked immediately.
Okay, so that brings us to the red team challenge.
The ultimate inversion of the bull case, which every owner must consider. Investors today are paying a premium tech multiple, a multiple of 25 times earnings, and up for a phenomenal growth platform.
So we have to ask the critical question. What if regulators eventually succeed in forcing Airbnb to act like a utility or a traditional hospitality chain rather than a neutral technology platform?
This is the unregulated hotelier trap. If governments mandate extremely burdensome verification processes for every single listing, require the platform to collect and verify localized taxes across hundreds of fragmented jurisdictions, and severely limit the number of nights a host can rent out.
As we're seeing in the most restrictive cities.
Exactly. The operational costs of the company will explode. They would have to massively scale up their administrative and compliance staff.
It changes the entire cost structure.
The result is an operational cost base that becomes asset-heavy in terms of operational expenditure. Their unique supply shrinks dramatically due to host fatigue, and their industry-leading FCF margins compress toward hotel-like levels.
So if the platform's unique inventory, the very thing that gives it pricing power, disappears due to political action,
They risk becoming an inferior, more complicated Booking.com with limited growth potential. That scenario would force a massive and permanent multiple contraction, regardless of the founder's enthusiasm or historical efficiency.
that is the essential conflict for any investor looking at OBNB. The fundamental quality of the business is world-class, perhaps generational, but the analysis must center entirely on the durability of the unique supply and the political tolerance for its existence globally.
Absolutely. So as you continue your own research and deep dive, here's a provocative thought to explore. If the market's biggest fear is regulation in major global cities that are already saturated, the Barcelonas, the Parises, the New Yorks, where should you, the long-term owner, look for the next wave of supply growth that is currently entirely overlooked by city councils and regulators? And does the company's clear and heavy focus on long-term stays, which bypasses most short-term rental ordinances, fundamentally inoculate it against the risk of the regulatory environment entirely?
Food for thought indeed. Thank you for joining us for this rigorous analysis on Airbnb. We look forward to seeing you on the next deep dive.